Well, good afternoon, everybody. My name is Agarwal, and I will be the moderator for this session, which is titled The Private Sector's Role in Carbon Markets, a welcome mat or an exit door. As the title suggests, in this session, we will examine whether the current regulations and guidance initiatives are encouraging or discouraging private sector participation and investment in carbon markets. You all are here today, and certainly the panelists are here today because we believe in the power of carbon markets. We believe that, that private sector investment and participation in the carbon markets is essential, not just in achieving the sustainability goals, but also the long-term goals, the long-term temperature goals of the Paris Agreement. But what does the ground reality really look like? How welcome does the private sector truly feel? Are there enabling conditions for participation? And so in this session, we will attempt to answer some of those questions. And we've got an excellent set of panelists with us to do just that, and they will introduce themselves in just a minute. But before they do that, just a quick note on format. We will have a discussion for the first 30 or 40 minutes, followed by a set of questions from the audience. I will give you a 5-minute warning before the last question in our discussion so that you can get your questions ready and we can keep those questions succinct so that we can get as many of you as feasible within the hour. So with that, please help me welcome our panelists with a round of applause. Marisa, Hamsik, Rina, Cerrato, Luke Oliver, and Rob Lee. So very briefly, in that order, please tell us who you are and what you do at your organizations.
Sure. Hi, everyone. I'm Marisa Hamsik, and I am the General Manager of Strategy and Market Intelligence in Chevron New Energies for our offsets and emerging technology business. And just briefly, Chevron New Energies was started about 2.5 years ago to build businesses that can help Chevron decarbonize, lower the carbon emissions of our base business, as well as build lower carbon businesses for the future. So that's across CCUS, hydrogen, offsets, and emerging technologies.
Great. Hi, everyone. I am Rina Cerrato. I'm the Chief Commercial Officer for Greenstar Royalties. Greenstar Royalties is a capital provider in the carbon market space. We are trying to innovate in this space by bridging the gap in financing and providing that capital upfront.
I'm Luke Oliver. I am the head of climate investments at KraneShares, which is a more traditional asset manager. We operate in the ETF business, and we manage some carbon ETFs, both on the compliance and on the voluntary side.
And I'm Rob Lee. I'm the Chief Carbon Officer for Catona Climate. For those of you who don't know us, Catona is intermediary. We sit at the intersection of supply, demand, and capital within the voluntary carbon markets. So we try to bridge the chicken or egg problem of carbon finance by bringing together all three elements of the triangle simultaneously. So we work with early stage projects to get them up to a certain point of maturity to be able to connect to enterprise off-takers we have partnerships with, and then use the enterprise offtake signal to de-risk the price risk from that project in order to obtain carbon financing.
Great. So let's dive right in. Do we believe that enabling conditions exist for the private sector to transact in the voluntary markets? So Marisa, you first. Do you see a welcome mat or an exit door?
Yeah, so I will answer that question. Just to ground a little bit, so the reason Chevron is building an offsets business is to invest capital, similar to how others are doing, to build a portfolio of high integrity credits for our compliance obligations, so places like Australia and California, but also for our net zero aspirations, our voluntary net zero aspirations, so building a voluntary portfolio as well. And I would say, in the metaphor of the panel, that we feel a little bit like in the voluntary space, the door feels like maybe it's like shutting a little, and we're like sort of trying to stick an arm through and saying, no, wait, like we still want to participate in this market. And what I mean by that is that there are some enabling conditions that I think are really positive signals. We have, standardization that's starting to occur on the supply side with the ICVCM and, even some governmental efforts to try to regulate what quality looks like on the supply side. We have innovation in the market happening in the MRV space, new methodologies that are trying to really adopt some of those technologies or new techniques to help correct for or mitigate some of the risks on the supply side. We have ratings agencies. So there's a lot of things that are happening to try to increase the integrity and give buyers confidence in what's happening on the supply side. On the demand side, that's where we struggle a little bit. And what we're really seeing from a lot of the multi-stakeholder efforts that are in the market right now is good efforts with positive intent, we assume, to try to help the market mature, but in doing so are putting forward ideas that we perceive as fairly constraining on acceptable and legitimate use cases for voluntary offsets. And that puts us in a little bit of a challenging position where maybe it is causing some unintended consequences, where when there's so many constraints, so many prerequisites, so many restrictions on when it is acceptable to use those voluntary credits, puts a lot of risk and uncertainty into the system, makes it hard for buyers to invest with confidence over the long term and really know that those offsets are going to be able to be used against our net zero aspirations and our net zero targets. And I think that's concerning, that could lead to buyers potentially turning away from this market, which would be a bad outcome for the climate, for communities, and for the companies themselves who are genuinely trying to innovate and find solutions along a range of options of how we're going to meet the energy transition challenges.
Great. Yeah, I want to pick up on the standardization and possibly how that might be constraining in just a minute. But before I do that, Rina, from your perspective, what do you see, a welcome mat or an exit door? Where do you fall on that sort of spectrum, on the two ends of that spectrum?
Somewhere in the middle, I would hope. Just echoing what Marisa was saying, there's a lot of good intention within this market, but I also think that there's a lot of noise within this market. It makes it really difficult to have financiers like ourselves act without really getting the clear signals of the market of is there going to be liquidity down the line. So Greenstar Royalties is bringing the royalty model into the space. This is really familiar in more of the minerals sections in terms of like mining, oil and gas, where we are looking to provide that capital and then get revenue from the share of the sale and the carbon credits. But that is a very important piece for us to make sure that there's going to be liquidity in the market. And we see liquidity in a bit more liquidity in compliance markets, but we're not necessarily seeing that within the voluntary carbon market space. The voluntary carbon market space gets called as, it's a very new market. It's really in its nascence. It's not. This market has been around for a long time. A lot of us has been in the space for a very long time. And I believe that what we're experiencing at this moment, it's an evolution of the market, but with net zero and carbon neutrality and all these terms that have gained popularity or attention, to put it that way, it's a good thing because it's bringing attention, it's bringing money, it's bringing funding, finance, different players and actors, but at the same time, it's getting really confusing.
Yeah.
There's too much information. The new participants in these markets are drinking from the fire hose, trying to figure out where to take action and what to do. So I wouldn't necessarily say it's an exit door. I think we all want to act into the space, but it's getting a little bit complicated, and the guidance that is coming out, it's well-intentioned, but to Marisa's point, it can actually have the adverse effects of creating stranded assets or making it too complicated for buyers to actually act. So if we don't have the buyers, we don't have that demand, then we won't get the liquidity that we need to actually get to the goals that we're trying to achieve.
So it sounds like we've over-indexed on the supply integrity and perhaps created some of those stranded assets whilst not creating the enabling conditions on the demand side. Would that, yeah?
Yes.
Great. Well, thank you, Rina. Luke, from your perspective, what do you think of this?
Yeah, so I think it's definitely welcome mat, not exit door, but there's muddy footprints on the mat and the door's squeaky, and maybe it needs to be repainted. So it's been quite discouraging. But there is, you see the conference here, you see the amount of people, entrepreneurs, capital flowing into startups and the companies and the platforms around this space. So there is money flowing, but the big end of the wedge is the money that gets invested. I think we'll talk about sort of 10xing and 100xing, but like the real capital flows that need to get into this market, that isn't flowing. And I think that, so on the supply side, I'd agree with everything that's been said. Everybody's saying there's too much demand, there's not enough good supply, we need to supply, we need money to do that. But it doesn't ring true because you can never, I don't see the person that wants to buy these things. And if I did, then either they would already be investing in these projects, or I would say, oh, this is a no-brainer for me. That person wants it, and I can invest in producing it at a lower price than they're willing to pay for it. I'll do that all day long, and I'll raise capital from investors to do that all day long. But I don't see that buyer, and I don't see a broad enough spectrum of buyers to have that transparency to do that. So I think that's what's missing. So it's definitely sort of on the demand side. And when you talk about the compliance market, standardization, I can tell is going to come up here, but the compliance market is very transparent, it's very clear, it's very regulated. And just to put it into context, we launched some compliance funds and we launched the VCM fund. And at the peak, we raised $2 billion in the compliance, and we raised about $10 million in the VCM. And the VCM dropped by 95%, and the assets went down to sub $1 million. And the compliance markets have been great diversifiers for investors. They've been robust, they've been volatile, but because they've been low correlate, they've been real assets, real asset classes. Even since we launched them, even with the bad performance last year, we're still like an annualized 20% a year return. So it's a real investment that gets real institutional flows, and that's why there's dozens of hedge funds, dozens of ETFs like ours and mutual funds that get exposure to this, and almost none in the VCM space.
KraneShares manages several different ETFs, and what you're alluding to is the compliance ETFs are the ones that have been performing well, including last year. And there was reporting a couple of weeks ago that you plan to wind down the voluntary ETF.
Yep.
Do you want to speak a little bit to what that decision was?
Yeah, sure. And for the question I've had a few times in the last couple of days was that I forget which publication it was, but they were behind a paywall, but the headline said KraneShares shuts down key carbon fund. And obviously it wasn't a key carbon fund, it was the one that we had with no assets.
A small one, right.
that we decided to close because nobody wanted to invest in it. So it's not that newsworthy, but I think, but actually it does tie back to this panel, which is a lot of people said, oh, it's a sentiment thing, you don't believe in it anymore, the performance was bad, is that why you closed it? None of those were the reason. We closed it simply because investors weren't ready for it. And I think we're going to wait to come back to this market. And what I hope happens, hope doesn't happen, I hope we are able to come back to the market with a better product in time to catch this market flourishing. And I think, so there's a risk for us that we're out of the market and then things are going to start to get better before we can get back in. But what's important though to note is for us to come back, we actually need better capital market tools. Like the futures that we use to get exposure to VCM, if you think about an oil futures contract, it's a very tight, specific grade of oil. And so you know exactly what that grade of oil is when you buy an oil future. With the VCM futures, it's such a wide basket that some of it is very good and high priced, and some of it is not very good and not highly regarded. And the future will price to the worst stuff in the basket. And so we don't want to expose investors to that. We want to give them a product where we can have some ability to tailor the quality.
Great. I want to come back to you on what your investors are asking you about compliance markets in a minute. But Rob, initial thoughts from you. Guidance, initiatives, current regulations, encouraging or discouraging?
Yeah, I think the emerging guidance and all of that, I think it goes back to kind of where we're at in the market right now is fundamentally where we sit. what we see is a transition period where we've got a mismatch of available supply with what we see corporate demand being in terms of the types of credits that they're actually looking to procure. And so we've been able to have some success in terms of forward offtake and forward contracting of projects that are in development that are tailored to that demand signal.
Yep.
But it's a very challenging formula because what we're hearing is everyone wants permanent removals with strong ecological co-benefits and social co-benefits with strong revenue sharing, but at a really low price point. And that's just not possible, right? And so, but there are projects that are trying to do that, trying to achieve that, but they're not going to deliver until 5-10 years down the road.
Right.
So I think there's a encouraging forward demand signal for credits that everyone kind of agrees are high quality and will remain high quality. And I think there's going to be some kind of turbulence in the meantime.
Great. And you just announced a transaction with Microsoft.
We did.
For a purchase of 350,000 tons.
Yes.
Congratulations.
Thank you.
So tell us a little bit more about that. Just how did that come about? And despite low prices, the absence of that product, you were successful. So just speak to that a little bit.
Yeah, we work with a really great NGO called Trees of the Future. They've been doing really wonderful work, and we're interested in developing a carbon project. So we funded them to start developing that project. We've been working with them for, I would say, 3 years to get that project to a point where it's mature enough to pass the muster of the intense diligence of these corporate off-takers like a Microsoft.
Mm-hmm.
And we were able to work with Microsoft, work with Trees to get that deal complete.
Great.
Yeah, it was a long process. We're really proud of the project. It was actually just recognized by the UNEP as one of the flagship restoration projects. So there are projects out there that are being able to have some traction, but they're few and far between because the criteria are so specific.
Excellent.
Yeah.
Luke, just to pick up on what you mentioned about compliance markets and investors. So maybe investors not so ready, I think you said, for the voluntary ETF yet, but still interested in compliance, and that's been your focus. In your discussions with clients, how focused are they on regulation? What are they asking you about where regulations sit? Do they view regulations for compliance markets to be encouraging or discouraging investments?
Yep. Well, compliance markets are regulation, and they're the proposition to an institutional investor is very clear. You have law. You have a scheme backed by law. The demand is mandatory, backed by law. Yep. The supply is completely transparent, completely, it's government issued, it's standardized, it doesn't decay, it doesn't go bad, you can transfer it easily. It's almost, well, I've got to be careful with the compliance talk, but it's almost the perfect asset, right? It's completely transparent, standardized demand. It's managed to indirectly rise in price by having the supply managed, and that is reset and adjusted based on where demand is going. And it's also almost the purest play you can get on climate action, because by the price going higher, and I'm not sure how familiar, I know this is mainly VCM crowd here today, but the compliance market isn't backed by any project. It's simply a permit issued by a government, but it has the effect of reducing emissions because that credit is sold. That revenue then goes towards R&D and green initiatives. But more than anything, by putting a price on carbon, you start forcing companies to reduce their emissions and basically start optimizing for their emissions. Humans are great at optimizing every other input into a business. We never did that for greenhouse gases because they were free. Now there's a price, we change behavior. So investors love that because the impact is quite clear and the economic story is very clear. When you go to VCM, I think Rina said this, you were talking about how it's not, I can't remember how you said it, but it's not a new market, it's been around, but I think of it as still a frontier market. Mm-hmm. So it's not new, but it lacks a lot of the guardrails and characteristics that make for a very solid investment, institutional grade investment. So it's very important, and I think that's the secret here will lie in how we get the VCM to have more of these characteristics,
Yeah.
where it's a lot more transparent what you're getting, how you're getting it, how you're supposed to use it, how that's recognized, and that's really the difference. And and it's very clear. You see, the compliance market's traded about 800 billion last year, and VCM we all know the numbers, 2 billion or whatever that kind of top number is.
It's going to be a $1 trillion market. That's what we've all been thinking about and hoping for. But to move from the compliance to the back to the voluntary market and the standardization absence of it, or the attempts at standardization, there are initiatives like the VCMI, the ICVCM that tries to come up with standards for supply side integrity, SBTI that offers decarbonization pathways and target setting for companies hoping to achieve net zero, Oxford Principles and others. Marisa, all of these different initiatives on the voluntary side, they all serve a slightly different purpose. Are these initiatives helping you and others build a business case for the use of credits by corporates?
Dramatic pause. So we support, we do think that standardization conceptually is probably going to be needed, or is certainly very helpful to scale the market to the level that we say that we want, and to make it look a little bit quasi more like the compliance markets that Luke is talking about, where there's some clearer guardrails. However, what we are really seeing right now is that, the business value for a compliance offset. So, if we are going to make an investment in a project that can meet a compliance obligation in Australia or California or other compliance markets that accept offsets where we're regulated, we can make that investment all day because of the compliance obligation. We have to have the same burden on the voluntary side. We have to build a business case internally to do that. And what we're seeing with a lot of these guidance standards right now on the demand side, as I alluded to, is that offsets are being relegated to an additional activity outside of your target. It's beyond value chain mitigation, above your target, or it is, in the case of the VCMI, you're meeting your target, and then you're also investing in offsets to make certain claims. Some suggestions of only using offsets if you miss a target. None of these signals are particularly helpful for companies and investors like ourselves who want to put capital to work now to build a portfolio of offsets that we can use over the long term as part of our efforts to achieve our targets or our ambitions. We see offsets as one of the tools that we have to develop a suite of solutions around our lower carbon portfolio alongside internal abatement and the businesses that we're trying to build for the future. And if you take away the ability to use offsets in that diversified, lower carbon, net zero oriented portfolio, you take away the business rationale and you relegate offsets more to kind of a philanthropic bucket. Yep. And maybe that's okay, but that's not a market-based mechanism to price carbon. That's not, in our view, a scalable solution if we want to get from a few 100 million tons a year to gigatons a year and really unleash the capital of companies like ours who are hard to abate and have real emissions reductions we're trying to achieve at scale. And I understand the challenge or the concern that if somehow these very constrained use cases don't exist in the marketplace, that there might be a trade-off between like an offset-first strategy and internal abatement. That, for us, that's not really how conversations play out internally. We're trying to build businesses for a carbon-constrained future, and those solutions that we are trying to develop for internal abatement and for those future businesses need to be done along what is economically and technologically feasible. And then in addition to that, we would like to use offsets in an appropriate way to achieve our aspirations. But I don't see it as much of a trade-off where if we use some offsets, we're somehow going to do less internal abatement. We're really taking a both-and strategy. And what I'm potentially concerned about is if these guidance documents get enshrined in some way and the use cases become so constrained, there's probably a risk that offsets end up in some kind of, it's all too hard bucket. And the market or the buyers who intend to retire and use these credits turn away from that market. And I don't know how they return. So we don't want them turning away.
Yeah. No, I think the point about making sure that carbon credits are not relegated to the margins as an optional charity use case is absolutely important, and I think that rings true that does not help create demand if we are simply thinking of that as things you do in excess of scope 1, 2, and 3, and you do all of that, and then if you have some money left, you should go and we're recommending that we will go and buy carbon credits. That does not create necessarily demand.
Not at scale in particular.
100%.
Yeah.
Because charity is not scalable, so we're not going to be able to get there. Yeah.
It's a tough internal business case. Yeah.
Rina, you spoke a little bit about unintended consequences. I want to get a sense from you, from your perch. Do you see some of these initiatives as having unintended consequences?
Well, I think they do. I think let's begin with the fact that I think that many of these initiatives have really missed the mark in terms of what a carbon market really is, and allowing the options for low cost abatement as well. To have flexibility, I guess in compliance we call it flexibility for compliance. We are not allowing that within the voluntary carbon market space with these guidelines. These guidelines are all about decarbonization, and then you can think about offsetting, and then it's a contribution, it's not a compensation. It becomes a philanthropic budget rather than part of your corporate strategy. And by not recognizing that actually carbon offsets do have a role to play in the overall strategy of meeting our Paris Agreement, we are inevitably creating the sense that therefore carbon offsets are not really good, because for some reason they don't fit within this whole decarbonization definition and strategy. But in reality, decarbonization is expensive. It takes time. You're looking for technological advancements that may not necessarily be available within the decade that it's needed. So why are these initiatives not necessarily recognizing the need to actually allow companies, corporates, actors to take offsets as part of this is how I'm going to achieve this strategy? And it's not, we want guardrails for sure, but I think in doing these guardrails, we don't have to narrow down the use case, and it doesn't have to be like this is the only way that you can achieve things. There should be guardrails, but these guardrails should allow corporates to define what that strategy is for them. If we look at the latest release on the, beyond value chain mitigation, when I was reading that, to be honest, I was just in disbelief, because I was just like, are you kidding me? What are you asking companies to do this? Like, if you actually read what that guidance is saying is, well, okay, this is above and beyond what is within your value chain. But in order for you to know what is going to be above and beyond your value chain, you also need to quantify this, and then you need to take into consideration what is going to be outside of that, and budget for that, and revisit it every year, and have it verified, and have it nope, I'm not going to do it. You're making it complicated. You're making it hard. You're making it unnecessarily narrow, right? So we don't want the buyers to. Please don't leave, Chevron.
Not going anywhere.
Please don't leave. I mean, in reality, we need everything that is available today to reach our targets for 2045, 2050. We cannot say that there is one solution that is going to save us all. We need to allow for everything to evolve. We need to allow for this market to evolve. We need to allow for companies and corporates to define their own way of achieving the targets that they themselves know and set, and they're going to be constantly evolving. As a constantly evolving target, your strategy is always going to change.
And I think if you can include a use of some use case for carbon credits as like you said, a low-cost abatement measure as part of a company's decarbonization strategy, that then also allows folks like Rob to get that purchase order, so to speak, from the likes of Microsoft and others, and that spurs the entire industry to start taking action and start putting money into projects that matter. There's also a social equity aspect of it, a climate justice piece to it, if you will, where a lot of communities benefit from a lot of the nature-based projects that Rina, you invest in, and Rob, that Catona will be developing going forward. And just to say this, that we're in the state of California, where the regulator themselves, they have allowed for the use of offsets. Historically, that's been 8%. Now it's 4%. It'll be up to 6%. And so which has benefited to the tune of tens of millions of dollars Native American tribes that have benefited from the fact that the regulator here recognizes the role of offsets as a cost containment measure, as a way to channel finance towards communities that are doing the hard work of reducing those emissions. So the role of offsets is very well established, and I think it's somewhat a shame that the standard setters are not recognizing what the regulators have recognized.
And let's not forget too that the intention here is to bring more participants and bring more people into the market space, right? So in compliance, you will have the large emitting sectors are the ones that are being covered, but here we have an opportunity to have a broader reach. And if you're making it complicated to this level, then there's going to be no action.
Yeah, absolutely. So if that's the case, if these are so complex, if they're not bringing in new participants, how relevant are these standard setting bodies? I mean, Marisa, for you, I mean, is it important for your company to adhere to these standards? If these are sort of the independent environmental standards, but if they're not serving that purpose, how important is it for you to adhere to them?
Yeah, I mean, it's a good question. They certainly set a tone and a direction and start a conversation, force a conversation. They're sort of quasi-regulatory, and as you said, that does give buyers some sort of cover in the world where we probably were in 2023 of, I'm buying offsets and I'm also buying risk. That also is a scary place for buyers to be, and so I understand the intention to have some guidance on both the supply side and the demand side. What kinds of credits can I buy, and when can I legitimately use them? But if the use cases remain as constrained as they are, I mean, Chevron is not, we don't meet the prerequisites, and there is no oil and gas methodology for SBTI. We don't meet the VCMI prerequisites, and I think a lot of companies don't. We will continue to set the strategy of how Chevron intends to deliver on its lower carbon aspirations and the role of offsets, within that. And I don't know if we're getting into the visioning of what we'd like to see, but I'll go ahead and go there. That it would be great if what the signals that we were seeing in the market are, and kind of the guidance that we're seeing, focused a little bit more on raising the bar around transparency and expecting companies to transparently explain their lower carbon pathways and the suite of options that they're trying to implement, including the role of offsets within that trajectory, and letting companies make their own choices. One of the things that it reminds me of that I was thinking about when Luke was talking is, even in the regulatory markets, governments don't dictate what a company should be doing. They don't dictate how many emissions reductions one must achieve before one can buy an allowance or retire an offset. The regulators just set a price on carbon, through a cap and trade system or baseline and credit or whatever the mechanism is. But the expectation is that you company A, B, and C, you make whatever choice you want to make, but for your emissions, you have to retire an allowance or an offset. Is it better for you to do that in-house internal abatement or to buy something from the market? You get to make that choice every quarter, every year, as you were making complex capital allocation decisions around how you want to run your business, technological advances, policy changes, customer demands, supply chain. I mean, there's a lot of decisions that companies need to make in this very complex energy transition world we find ourselves in. And the VCM trying to kind of dictate that feels a bit like the tail wagging the dog.
Very good. Rob, standards, are they relevant? Do your corporate clients care about them?
Yeah, I think there's maybe two categories of our clients where one is, well-resourced. They have a big team, an army of consultants that's helping them, develop their strategy. They're able to transparently report on everything they're doing. They have a very coherent long-term strategy that they're reporting to. And to those, those clients and those partners, these standards are maybe like behind what they're already doing. They're already out ahead of whatever the kind of bare minimum that these standards organizations are pushing other corporates towards, and so maybe not so important for them. But I do think, and I want to separate maybe like the process from what the purpose of these standards are doing, is that I think it's important that we have some consensus building within the market around what credible offsetting looks like and what a credible program looks like, because most corporates have maybe one person doing everything sustainability,
right?
And for them to have to try and create a full strategy and report on it and execute on it, and it's too much for any corporate to be able to do. So having a pathway that's pre-made and set for an organization to follow, I think that's incredibly important. I think where maybe there's been some challenge is that for whatever reason, I think the standards organizations have purposefully or inadvertently kept the industry and kept corporates at arm's length, maybe to try and keep it, quote unquote pure, or like not influenced by the market or the industry. But I think that that's kind of led to this divorce or kind of separation from what's actually practical and implementable, and I think that's kind of where I land.
Mm-hmm. And I'd love to just add something to, I think, what a couple of you said, and Marisa's point about standards. It's not about telling people what to do. That, as an investor, you want to know that there's rules to the game, and then you want to play the game and have a fair shot at playing the game. So you don't want to, if someone tells you what the outcome is, then there's no risk and then there's no return. You want something where you can approach it and say, okay, I understand this risk and I understand this return, and this is how I'm going to approach it. And so that's the sort of, it's those kind of guardrails. So I talked about oil earlier. No one ever told you what you have to do with a barrel of oil, but it has to be a certain standard for a certain contract. And same thing, doesn't mean you apply that directly to carbon offsets, but the idea is whether you're hedging, whether you're using derivatives, all of these things are up to you and how you approach it, and which type of credit you're interested in, and what quality factors are important to you. But it's just knowing that there is an infrastructure around it, and I think that's where we all want the capital. Basically, the way I think about it is, we've launched a bunch of ETFs on the New York Stock Exchange, and everybody says that's the home of capitalism, the New York Stock Exchange. We have to file a prospectus that's this big. There's the SEC, there's the New York Stock Exchange itself. The amount of regulation around listing a security on the New York Stock Exchange is immense, and it doesn't feel very capitalist when you're filling out all this paperwork. But that's the point. You set the rules, you have a robust system around it, and then you let it go nuts, and you let it go and play out, and there'll be winners and losers. But that's what brings in real capital.
Great, makes sense. Rina, you want to comment on this?
I just like what Luke said about how, with the SEC and the New York Stock Exchange, you're filing your perspective, and it's basically saying, this is what we're going to do.
Yeah.
This is how we're going to do it. It's within the rules of the game. Why can't we have that within the carbon market space and the voluntary side?
Yeah, good. So I have one more question for our panelists before we turn to the audience. So this is your 5-minute warning to get your questions ready, and then we'll try to get in as many of those questions as we can. So before we turn to the audience, just finally, in terms of just thinking more constructively and the path forward, we discussed perhaps the overbearing nature of some of these standards, perhaps the absence of clear guardrails. What can groups like the ICVCM, VCMI, SBTI, others, as well as governments, what can they do to scale up the flows of climate finance via carbon markets by a factor of 10. So if you have to 10x it, 100x it, if you want to move from that tiny little 2 billion market in the VCM to 200 billion market, which I think is the job that Rob and I signed up to do when we got into the carbon markets. How do we get there? So maybe we'll start, Rob, with you, and then we'll just go in that order. Yeah.
Sure. Yeah. I think the fundamental challenge of getting it to a step change in size is really we just need more demand. We need more demand creation, and I think that's really the one thing that's hindering everything, right? Like, there's enough. There have been companies that have been buying carbon credits. More or less, they're still buying carbon credits. But there's an entire universe of companies that is just not doing anything.
Right.
And I think that we need to get to those companies to create a viable decision-making process for them to actually look at carbon credits and say, this makes sense for my business, right? So that's either going to have to be from regulation or some sort of compulsory action, or there needs to be some clear linkage between participating in the carbon market and benefiting your bottom line. And I don't think that second link has been made yet. So I think it's either regulation or that, and that's kind of where I land. Yeah.
Great, Luke.
One thing is that I think it's all part of the process, but it might not be a popular thing to say, is that we need to first thread the needle of the first principles: project finance, delivery, purchase, retirement of the credits. And there's so much noise, and it's a little bit fatiguing as an investor to meet, and I hope I'm not offending anyone, but to meet another platform, another exchange, another technology that's going to just create transparency and all these things. We need all these things, but all the energy should go into this primary trade. I'll use the New York Stock Exchange again as an example. Guys used to meet under a tree on Wall Street, the Buttonwood tree, and there was a need where people owned companies and they wanted to raise funding, and they would sell a share of their company. Eventually that built up into them having their own room to do that, and then it turned into the New York Stock Exchange.
Yep.
Now we have derivatives and futures and options and completely global markets all interconnected. We can do it a lot quicker than 300 years or whatever of stock exchange history, but start at the beginning. I think everyone's jumping to this, like, we're going to trade these and there's going to be a liquidity. We don't need all that. We just need to thread this needle and get that moving. So that's one thing that needs to happen. I think that will naturally happen. Is probably each time the market sells off here, we probably get a bit of a washout or a shakeout. That's probably healthy. But the other side of it is, more to your question, on the we really need this regulation. Absolutely anything important has regulation and standards, whether it's food, medicine, I'm completely blanking on it. The gauge on the railway lines, that was a whole thing that wasn't standardized and was a mess, and then they standardized it. And so anything important, and I think this is important, needs some standardization and some clarity, and then the money starts to flow and the users start to have confidence in the product, and then you have a market. Then we can build high frequency trading models to trade carbon offsets if we want.
Never heard the reference to Buttonwood Tree and Wall Street in a carbon conversation. But that's always a welcome addition. Rina, what are your thoughts?
All really great points. I would also think that all the guidance, all these initiatives, including governments themselves, need to stop being so reactive.
Yeah.
And start being proactive. And start thinking about, if we want to achieve action, then these are the things that you need to do, kind of like as you were saying, everything has a standard in terms of like food, corn, all these different commodities have rules of the game. And if we want to achieve this, then okay, these are the steps that you need to take that are going to be leading you to credible use cases of the offsets and your decarbonization strategy. And instead of, well, there was this bad article out there, so now we're all going to start putting in, the hand behind the whole sort of disclosure bills in California here in terms of like, well, now you need to disclose, and then the additional bills of well, if at some point you had some sort of awareness or knew that maybe it wasn't additional, or
Right.
you know, you start putting all these things that are, instead of creating demand or creating a place for the markets to evolve, you're creating a place where nobody wants to act because you're being exposed to too much liability.
So perhaps those regulations are solving for a problem that doesn't quite exist, instead of actually, it's a solution search for a problem, really, the bills that you referenced.
Instead of actually allowing for action.
Yeah, clear. Marisa, your final thoughts?
Yeah, just, you know, reflecting on Rob's point in particular, just this opportunity for demand creation and, you know, giving buyers confidence that this is a legitimate tool in the complex world of how we're going to live in a lower carbon and net zero future, that I think governments through regulatory action or, you know, multi-stakeholder guidance that comes out of the private market that is really pushing for transparency on your pathway and disclosure around how you intend to use offsets, and then potentially some supply side, you know, characteristics around what kind of offsets, sets the architecture for buyers to tacitly or maybe explicitly be able to point to something that says, oh, it's okay. It's okay if I use offsets as one of my solutions, as long as I'm methodical and clear about how I'm going to do that, track that over time to the best of my ability, use high quality credits to the best of my ability, and, you know, off we go. We need the clarity and simplicity brought back to those demand signals. Otherwise, we're probably just going to be mired in this kind of sort of percolating market that kind of just, you know, potentially contracts, but certainly does not scale to the levels that we've all said we want.
Great.
Well, most people have said
Most
they want.
people have.
Yeah.
Great. Well, that concludes the panel discussion. Rachel in the front here has some microphones, and we'll take some questions now. Just when you stand up, please introduce yourself and your organization, and please speak into the microphones so that those that are dialing in virtually can also hear us. We've got a couple of questions in the front here. So Rachel, maybe we start with the table there, and then we go over to the next one. Yes.
Hi, Shahira Ismail with BMO Radical. First of all, thank you so much. Like, this has been such a refreshing discussion, and I think these are the types of discussions that we need to have to move things forward in the voluntary market, so thank you for your perspectives. Marisa, I just want to actually tag on to what you were saying right at the end there. Can you flush out a little bit more? We know we have the VCMI, we have the ICVCM. It's taken years for us to get to this point. Instead of starting over in terms of some sort of demand-based or market-based standards, how can we leverage what already exists or the bodies that already exist and actually move that forward? Or do you feel like it actually needs to be scrapped, it needs to come from a different group? Do we need to scrap? No, and I'm not trying to say we necessarily have to, but just trying to push that a little bit further to understand it a little bit better.
My goodness. So certainly wouldn't say scrap it. The people working on these things are highly intelligent, I think well-intentioned experts, right? These are I don't genuinely, I don't always know if the intention is to scale the market or not. And there's probably still a place for a lot of these standards for different kinds of companies. I am speaking from the perspective of a large, hard-to-abate energy company. That is a very different set of use cases than small and medium enterprises, or maybe even technology or pharmaceutical or consumer-facing brands. They might have a different conversation if they were up here. But I wonder, and I would sort of invite the conversation with those groups, are the unintended consequences unintended? Is this about having more of a back and forth dialogue and seeing how we can tweak and amend and move a little closer toward something that is more workable for the buyers? And what could that look like? I mean, I was in a session yesterday with Alexia Kelly, who I'm sure a lot of you guys know, and she was talking a lot about VCMI and some tweaks and conversations potentially I'm going to say that many times because she did, potentially being able to use offsets within your scope 3 target. That's a change and a tweak that we're already seeing. So I think that you can build off of what exists, and you can look to some, maybe regulatory drivers as well that are coming out of Australia or other places. So no, I wouldn't say scrap it, but have an honest dialogue and see what we can build from.
Amy.
Thank you very much. Amy Zell with AIDA. Thank you for the fabulous discussion. Luke, I have a question for you since you were talking about standardization, and I've heard this from a few folks now. I'm wondering, what does standardization look like in terms of carbon credits? Is it a CCP label? Is it stripping off the co-benefits and only looking at the base ton of carbon? Tell me more.
Yeah, and I'd love the rest of the panel to chime in as well. When I think about it, and I don't get overly prescriptive on, so one thing I think is a bit of a challenge, but this sometimes gets a heated debate going, so I don't want to necessarily kick that up. But a lot of people talk about 1 ton is a ton, and this is less about standardization actually, but every ton is different, and when you talk about a compliance ton or a direct air capture ton or a red ton, they're clearly very different, and the pricing tends to reflect that they're different. But I don't always think that the pricing is different enough given those different calibers of credits. So I think one thing that is less standardization, but it's something the market needs, is almost like in pricing, sometimes we call it a surface where there's multi-dimensional factors, but really we should be able to price on these measures of quality. And so there should be some sort of way to, so what I find is a lot of people trying to say that a ton is a ton is a ton, and that's when the registry makes it a ton, it's a ton. And I kind of almost want to challenge that a little bit. And I think one way to do that is you actually price them very differently. And also maybe it's not about so this might be controversial, I don't know, but it's not about how many tons you buy. It's about, you could argue that it's about how much money you spend, which is a bit different. But the way I think about it is, if you had some standardization, this is where I think this might be controversial, but if you had a benchmark price of carbon, and a company says, right, I have 50,000 tons of pollution, at that benchmark price it's X dollars, maybe it's okay, it doesn't matter which credits they buy, provided they spend the money. And so you can either buy way more than you need of the cheaper things, or fewer of the things that are more expensive, but you're helping scale a technology faster, or you can build a portfolio across it as long as you spend the money. And so that's one. I think it's difficult, but to have some benchmark price that we're all looking to as a standardization, and then it doesn't matter what you buy as long as what you buy meets the these minimum requirements, and you spend the money. I think you can have the impact. So it's like, if this is a lower grade ton, but you buy loads of them, you can have as much impact as buying something that's more expensive. And then when it gets down to sort of into it, it is challenging. Like when you get down to standardizing, the way I think about it, but I'm putting this through the mindset of an asset manager building products for investors, is, so what was wrong with the offset product that we had? Or not what was wrong, but the tools available were too broad. I would like to have I'd like a bucket of like high grade nature-based removals with certain characteristics in one bucket, and then maybe industrial avoidance credits in another bucket. But when I've just got one bucket of everything, I'm really trying to get exposure to everything, but I'm really getting exposure to the junk at the bottom end. So for me, that's what I mean by standardization is sort of categorizations, where a little bit like the bond market, where these are double A's, these are triple A's, these are B's, something like that allows us to put it into a language that the investor understands.
I'm gonna jump in on this question a little bit as well. So standardization, I think, from a different perspective, it's really interesting just to hear everybody has their own perspective. But at the same time, to me, standardization versus, let's look to Shahira's question as well. Should we reinvent the wheel? Not necessarily. What are the good pieces of the initiatives that we have today? So we have the core carbon principles. You have these 10 principles. those should be part of your due diligence when it comes to buying an offset credit, right? The other thing for standardization for me is language, terminology, defining avoidance and removals. If we're not doing that, then one stream starts thinking, well, removals is the only way, removals are the only real credits, and it cannot be nature-based solutions. It cannot be nature-based removals. It has to be the engineered removals. Okay, but can we also talk about avoidance and what avoidance achieves today, and the fact that there are solutions that are available today? Their nature, their also technology. You have methane avoidance. You can apply it in different sectors: agriculture, oil and gas, energy. There's so many other solutions that are currently available. So if we can also start talking the same language, or at least using the same terms and not going interchangeably, which, you know, even with, well, net zero is the same thing as carbon neutral. No, it's not. It means, you know, very different things. So as we start looking at, okay, so there's the good pieces from these initiatives. There's the pieces of you should do your GHG inventory. Okay, great. But what about those that don't really have, they're not the large scale companies that have enough resources to even understand, to undertake a scope 3 inventory. I mean, nobody really knows how to do a scope 3 inventory. We can do scope 1, we can do scope 2, scope 3 is very difficult. So let's acknowledge that there are tools that these initiatives are referring to. So can we take the good pieces and let's start disregarding the points we're telling you, you can only use this if you've done X, or you can without really understanding the context and the nature of why corporates are doing this. So I think that as we start moving through, it becomes an education piece, it becomes everybody understanding, oh, well, it turns out that not a ton is a ton for some, and a ton from an asset management is a different perspective. But at the end of the day, I think what we're all saying is there will be different attributes to these credits that I will value them differently, but at the same time, they're still real reductions, and we shouldn't discard them just because they're not called a removal. We should stick to core carbon principles, for example. So you have 10 principles that are telling you that it has to be real, things have to be measurable, you have to have governance, you have to have sustainability components. I mean, they're kind of like a little bit no-brainers. So as we start repeating that same message and using that very same tools, I think that to me is what's going to lead towards that standardization.
And just like this, what you're saying is that those cheaper tons or those avoidance tons that maybe aren't very popular, but they are incredibly important.
Yeah.
And so I'd argue that instead of buying, say, a $15 credit, and there's a $3 credit, avoidance, it's not a case of buying 1 ton and saying this one's more expensive, this one's cheaper. Buy 5 of those, and then you sort of correct for that. You then bring the importance and impact up as much as the other one. Arguably, the pricing differences, you would be able to use that as a ratio of how many of those credits is equal to the other credit.
So therefore, your expenditure is pretty much equal regardless of where that credit was generated.
Yeah, and it almost suggests that if a credit's half the price of another, it's half as impactful. Like, you almost want to get there.
You're kind of recognizing that, no, there is still value on these other credits as well.
Exactly.
I'm just conscious of time, and we've got a ticking sort of watch here that's getting very close to zero very soon. So I saw a couple of hands. Really sorry we wouldn't be able to take those questions, but please come and find us after, and we can have that conversation. I want to bring this session to a close. Thank you all for participating, and thanks to the panelists.
Thank you. Thank you.